Welcome to this video. Here we will discuss some interesting factors, such as correlations, fundamentals, and a few alternative factors such as market inefficiencies. So let's get started. Correlation is used to identify the strength as well as the magnitude of the relationship between two variables. And correlation-based inefficiencies can be used in many ways to find microalphas. One example is the increase in cross-asset correlations during market corrections. But how can we quantify this? Let's look at the following example. First, we select a quiet period, over 6 months, from 2013 to 2014. And then, we select a not-so-quiet, global financial crisis period, such as 2008 to 2009. Next, we average the correlations with the underlying index. Plotting this shows us that the gradient of the correlation curve often rises sharply at the onset of corrections. Next, let us learn about some fundamental inefficiencies in the market. Information unrelated to price data is abundant. Perhaps, the most infamous and profitable of them is insider information. It is probably no coincidence that some US Congress members have the best performing portfolios, beating 99.9% of all hedge funds. Fundamental data also holds substantial information that can be exploited for microalphas. Trades related to US companies usually focus on the quarterly reporting period. One typical approach is to analyze anomalies in analysts' reports prior to earnings announcements. In many cases, the market prices are impacted by the earnings expectations. So if we can detect anomalies, we can sometimes predict an earnings surprise that drives the market in an unexpected direction. Alternative data is a wide field in its own right and leaves ample room for creative thinkers. One such strategy was created by a group that was able to infer the time players spent on the golf course per week by looking at their changes in handicaps, which are publicly available. Interestingly, they also found a strong negative correlation between the play times of CEOs and the performance of their respective companies. There are many other examples, and there is no limit to what can be discovered in that space. However, the difficult part is to tie in these observations with a quantitative strategy, and this could be the subject of a whole course for another day. So that was all for now.